Now, streaming now is somebody with a different point of view on this plan for the big banks. Rob Nichols is the president and CEO of the Financial Services Forum, a trade association whose members are the CEOs of the 19 largest banks in the United States. Good to see you, sir. Thanks for joining us.
Hey, nice to see you, Maria. Thanks for inviting me.
Your reaction to Senator Vitter and this new bill?
Well, a couple of observations. Obviously, we have a similar goal that no institution should be too big to fail, and taxpayer money should never be used in the case of an institutional failure, ever. That's a goal we share. But I guess a couple of observations come to mind. One is the economic impact of this proposal, Maria. A number of analysts that have already trying to quantify the amount of lending that would be impacted and the credit availability that would be sucked out of the economy if something like this were to occur. We're seeing numbers that are really quite staggering. We're seeing maybe perhaps as much as $3 trillion or even $4 trillion of less lending and credit availability at a time, Maria, where there's a fair amount of economic fragility. We have a very slow recovery. That's been evidenced by the jobs numbers and the GDP numbers. So I think that's one area of caution that policymakers should take into account. I'd also observe that, of course, these institutions have gone a long way since 2008 to improve the conditions, to make them more safe, more sound, more secure, more stable. You look at capital. You touched on very elegantly on liquidity. That's important. In terms of passing stress tests and living wills, they've deleveraged. The balance sheets are more solid. So a lot of progress has been made. And then one piece that you didn't get to cover in your interview with the senator is the international aspect of this. One of the provisions in this draft bill that they unveiled today would be to abandon the Basel process. And I think, you know, many think that probably we need more international cooperation given how global the capital markets are, particularly on resolution on some of these other issues. Yeah. And to turn our back on some of our international partners, I think many think is probably not the right thing for the United States to be doing right now.
Yeah, I think that's a great point. I'm glad you brought it up because the idea that there could be an international standard is so ludicrous, given the fact that you have so many local regulators all over the place coming up with their own ideas. But let me push back on you for a moment because sure. I pushed back on the senator. You know, the banks have gotten bigger in the past few years, right? So, you know, is capital really the wrong way to go, or is it the right way to go? Wanting more capital, a bigger cushion, just at a minimum tell the world that they're not too big to fail, and in fact they can take care of any issues in a distressed environment. Wouldn't more capital help prevent another taxpayer bailout?
Capital is just, well, first of all, there should never be a taxpayer bailout ever again. These institutions, should any institution fail, we need to have a regime where they can just fail, the management is fired, everyone is wiped out. That's the policy goal we all share. In terms of what makes our institutions safe and sound and secure, we want financial institutions, Maria, we want a capital market that supports financial institutions of all sizes, small banks, community banks, regional banks, and large banks. And with regard to what the supervisory criteria should look like to make sure they're safe, there are a lot of pieces to that. It's capital requirements, which, again, these have doubled since the crisis. It's liquidity. It's effective supervision. It's good management and internal controls, risk management and internal controls, an active and vigorous and rigorous board. So capital is one important piece, and I fully agree, but it's not the silver bullet that will simply make us more safe. Now, one thing that was discussed today in the context of this bill is the regulatory pressures facing the community banks. And I will tell you, Maria, we have a lot of sympathy at the Financial Services Forum for these community banks. They are facing acute regulatory pressures, and they do need some relief. They shouldn't be subject to Basel III, is at least my own view. And so we do want to foster a capital market and a financial sector that allows community banks to thrive, regional banks to thrive, and large banks. I mean, these large banks do things. They have a unique value that, with great respect to the Bank of Englewood Cliffs, you know, they're not able to do some of the same things that Goldman Sachs and Morgan Stanley, Wells Fargo, Bank of America are able to do.
Are you expecting spin-offs from some of these companies as a result of what we're hearing out of Washington?
I think it's too early to say that. We'll see where the legislation goes. But I would say is these banks over the last 4 years have become more safe, more secure. The market has forced them to make changes. You're looking at, well, some have grown, some have changed their business, their operations in a way that the market has rewarded. So we'll see. But we basically, listen, we never want to have taxpayer dollars ever again used in a bailout. Never. But this legislation, I just think, is the wrong way to go.
All right, we'll keep watching that. Thanks very much for weighing in. Really appreciate it, making it so clear for all of us to follow. I want to get more